Welcome to this new Santander Asset Management session. We just released our outlook for 2026, and we want to share with you our views on the markets, on the macroeconomy. I'm Delfina Pérez, Head of Global Markets Content, and it's a pleasure to have with us José Mazoy, our Global CIO.
Thank you, Delfina.
Luis Felix, our Head of Global Asset Allocation.
Thank you, Delfina.
Jacob Ortega, CIO for Europe.
Thank you, Delfina.
And we will also connect with Francisco Simón, our Head of Investment Strategy. And when looking to 2026, our investment scenario is soft landing for the global economy and disinflation for most of the economies, with just a little delay in the US. We have to wait for inflation just to come down below 3%, but the disinflationary process is there. And this central scenario is supported by very clear factors. Economies are moving past the tariff wall because the average tariff for the US economy is being lower than initially expected, and moreover, economies are being more resilient to these changes in the commercial policies. On the other hand, inflation is not the problem anymore, it's not the focus for the market. Central banks are moving towards neutrality in terms of monetary policy in most of the countries. The ECB is already there, Fed is on the way, and we have the other central banks moving in that direction. And it's not only monetary policy, it's also fiscal policy. We have very clear fiscal incentives to corporates, both in the USA, in Europe, and this is a policy mix that is supportive for growth, for economic growth. So what are we expecting? We are expecting economies to continue growing during 2026 in this soft landing, as there will be some impact coming from tariffs, but overall, economies will recover dynamism at the end of the coming year. So once we have this central scenario, what would be the clear investment ideas where we can capture, or our clients can capture, this scenario, which is quite good? Jose.
All right, so thank you so much, Delfina, and especially thanks to our clients. We're very happy to be presenting today our market outlook for 2026. And effectively, what we're going to see is three main ideas. The first one is equities, global equities, so reaching new highs. So that is the first idea that we have. The second one, we're going to be discussing opportunities on the fixed income market. And there we want to distinguish between different regions, and those that are going to benefit more for the normalization of the interest rate monetary policy. And the third one is gold, right? So gold has had a tremendous rally this year, but we still see opportunities in gold as a structural trend, and we will be discussing that as part of our outlook. On top of that, we are also releasing on this particular outlook our capital market assumptions. This is a big landmark for us, given the fact that we not only provide returns for public market assets, but we have included this year also private market. This will allow us, as Luis will explain later on, to basically do mixed baskets or mixed portfolios that include public markets and private markets as well, right? So definitely is full of ideas, and I encourage you to please read it. Going into a little bit more detail on each of the ideas, right? I'm going to give you a few, just a few hints on what you can read in the report. The first idea is on global equities. And as the title says, we expect that we're going to be reaching new heights. Why is that? You mentioned a very benign economic backdrop, right? With the disinflation, monetary policy that is benign, also fiscal policies that are sustaining the economic cycle, less worries about the tariffs, right? So all these are very good elements that are going to be very supportive for taking risk, right? So we really believe that global equities is a very good, is very well supported, right? And it is not only very well supported at a global macro level, But as we go country by country and region by region, we find very good fundamental stories behind each of the regions
because
of the
we have investment teams in mainly all the geographies, the important or the geographies we cover in the outlook. So we have the local perspective and the local expertise to go to those markets.
And as we have mentioned, it is a very special year because we see that both the global story and the local story kind of point in the same direction, right? I will cover just a few points on each of the countries, but I do want to mention that as far as risk is concerned, we see little risk of recession or also a risk of rising interest rates, which would make the risk-taking activity much harder, right? So going country by country, and you can see all the details, of course, in the report. If we go to the US, now we think that there's going to be a broadening of the earnings expansion, right, beyond the technological sector, right, the technology sector. So that is part of the story in the US. In Europe, we are going to see close to double-digit growth in earnings. So that's also a very good story that I believe Jacobo will be covering later on. When it comes to Poland, Poland has had a fantastic 2025. Nevertheless, all the fiscal policy that we're seeing in Europe is going to be very supportive to the Polish economy. Here, we want to be a little bit more selective on where to invest. And in fact, we suggest to invest in small caps in Poland. Now moving to Latin America. In Latin America, actually, it has had a tremendous years or a tremendous 2025 of returns. And we believe that this year is going to be one of consolidation. And not only that, we see that the valuations in Latin America are still very attractive relative to the ones that we're observing in the rest of the world. So it's actually a very good place to be. We also then go to Asia, starting with Japan. So Japan finally is reaching more normalized levels in terms of inflation and interest rates. So therefore, we believe that there could be kind of like a nice reflation story due to this normalization that I just mentioned. And when we go to emerging market Asia, covering both China and India, also very good investment propositions for a little bit of different reasons. China, there's a lot of fiscal impulse, in particular in sectors such as innovation. So there we believe
there are tactical opportunities in the Chinese market.
Absolutely. And India is basically, I believe, one of the engines of that particular region, very well supported by foreign investment. So therefore, as well, we believe that is a good...
It's very interesting because you mentioned LATAM, and particularly the Mexican market is one of our investment ideas, and it was on the spot in the Mexican economy due to the tariffs, and things have developed in a quite favorable way.
Yes, absolutely. I think that, well, Mexico has been on the spotlight over the recent months because of all the tariff discussions that have occurred at a global level. But it turns out to be that Mexico has been one of the biggest, on a relative basis, beneficiaries of this particular tariff situation, right? And actually on the report, you see some very nice graphs that show you that the average tariff in Mexico is lower relative to basically the rest of the world, and lower relative to one of its main competitors, which is China, right? So therefore, we believe that Mexico, there's a very good opportunity. On top of that, there's a free trade agreement. The renegotiations are going to occur in 2026, which definitely brings a lot of optimism into the market. On top of that, lower valuation than the rest of the world. So Mexico has very good perspectives for 2026.
Yeah, so it's key to analyze fundamentals, because sometimes things don't move as initially expected, and then the opportunities arise. And you talk about valuations, and valuations is a key point when selecting the investment ideas in terms of equity. And on the last few weeks, there's been a lot of talk about valuations in the US market and particularly in the IT sector. So we are going to connect with Francisco Simon to know more in depth our views on the US equity market and what is our analysis in terms of fundamentals of the market and valuations there. So, Fran, could you elaborate a little bit on these topics?
Hi, Delfina. For us, the key for the US market is the solid earnings generation again in 2026. We're expecting the S&P 500 to generate around 15% in earnings next year and the equally weighted around 12%. We also see in small caps yielding around 20% and the technology leading again with 25% earnings generation this year. We are just basing this on our view on solid balance sheets in the US economy, policies that are just supporting the earnings generation and the cycle extending so that companies are in an environment for solid earnings and valuations. That we are aware that they are like in the upper end or in the upper bounds with highest percentages according to history, but this is consistent with the extending phase of the cycle. So we even see some opportunities in terms of valuation in the market, like in small caps where valuations are around the average and could contribute also to return in 2026. And this is because we are not expecting neither recession nor a change in monetary policy of the Fed that will imply rates going up. That will definitely be a source of concern for the multiple, but this is not under our base case scenario.
So very clear, Frank. Thank you very much. And now, Jacobo, the Eurozone market is another key market of these investment ideas. And what are the fundamentals there?
Well, I think as you can see in the report, we are absolutely constructive on the European market for 2026. We still think that this is going to be the fourth year in a row in which Europe is going to generate double-digit returns. And this is driven by a combination of different fundamental factors. On the one hand, we have valuations that are still attractive on absolute and relative terms versus the global market. Earnings is another element that we highlight in the report, in which, we are forecasting EPS growth of double digit, around 10%, which is attractive. And also, we tend to think that the positioning of investors from a global standpoint is still underweight in the region. Therefore, we think that this is a constructive environment for these investors to get involved into the European equity space once again. Inside the report, you can see also that we highlight two different countries. One is Spain, that is driven by economic growth above the average of the European Union, but also valuations that are even lower than the valuations that we have seen for the last years in Europe. And also Germany, that is going to be driven or is going to have a tailwind thanks to the fact that fiscal support is going to be strong and is going to generate, growth above average also for the European country. And those are like the main areas that we highlight on the report. And as I said, I think Europe has the fundamentals to beat or to generate double-digit returns for fourth year in a row.
Yeah, because the policy mix, but particularly the monetary policy part, what would be the opportunities we see in fixed income? Because interest rates have been coming down, but there are still opportunities.
So definitely. So the second idea is basically opportunities on the fixed income space. And there we distinguish mainly three countries, regions, right? The UK, Brazil, and the Eurozone. I like quite a bit the title in the report for the UK, which says that there are reasons for optimism. I think that the UK, because of everything that has been happening, raising taxes, inflation, low growth, there has been some pessimism around it. But one thing that we see, which encourages quite a bit, is that the government is absolutely committed to fiscal discipline, right? In fact, they have put out this stability rule in their budget, right, which commits to reaching a fiscal margin of around 10 billion in 2030, right? So we believe that together with the fact that the economy would eventually reach lower levels of inflation is going to be conducive to having a lower monetary policy rate, right? At the moment, the interest rate for government bonds, for example, in the UK is one of the largest in the G7. Definitely, I think that there's quite a bit of room for good returns in the case of the UK, right? Going now to Brazil. So Brazil is undergoing a period of stabilization in terms of growth, around 1.5%. Inflation is also coming to a 4% handle. So therefore, we believe that is also an environment that is conducive for a more lax monetary policy. Selic rate today is 15%. By the beginning of next year, we believe that it could go all the way to 12.5. So therefore, you could have
so it's a clear path that we're expecting.
You can have a capital appreciation of the bonds there. So when it comes to Brazil, we are also quite constructive in government bonds there, right? Finally, the Eurozone. Rates there, we believe that are at neutral levels, given that inflation is back on track. It's already there, right? So there we actually think that investment grade credit, which has been a really great asset over 2025, is going to continue to perform. There is still basically a healthy spread that could be captured. And I think that is also one of the ideas that we want to support in this outlook for 2026.
Yes, because in this investment idea, there is a clear support, Jacobo, on the demand side.
Yeah, definitely.
Investors there.
I think one might think that with the recent good performance that the IG space has experienced during 2025, and also looking at the spreads from a long-term standpoint, one might think, okay, maybe are we late to the party? We don't think so. We still think that fundamentals for the private sector in Europe are strong enough to merit lower spreads than they had in the past. There's also, as Delfina was mentioning briefly, the component of demand that is going to be strong, because we tend to think that absolute yields north of 3% are still attractive enough in an environment in which inflation is around 2% for investors to get involved into the asset. That's why we think that from a carry standpoint, it still has merits to be invested in the IG space.
Okay. So these clear investment ideas are supported in terms of global equity, in terms of opportunities in fixed income, and then gold, as you mentioned at the beginning. It's a good way to diversify portfolios, but also because fundamentals are strong. So we have all the pieces to compose these portfolios, because we have also the capital market assumptions you were mentioning at the beginning. So Luis, just give us like the big overview on these capital market assumptions and the importance they have for us.
Perfect. Yeah, so again, to talk about capital market assumptions is important to actually distinguish it then from the 1-year return, right? When talking about capital market assumptions, we're talking about a 7-year horizon forecast, which is pretty much what we use to build strategic portfolios, right? So again, one milestone for us, as mentioned, has been now being able to calculate capital market assumptions for private assets, which has been a joint venture with a team inside, let's say, the Santander Group, where private markets are actually being invested on. Going back to the capital market assumptions for global assets, as in the current standpoint, what we see are actually quite attractive in general capital expected returns across different asset classes. So if we actually focus into equities, global equities, 7-year forecasts, we right now are in the ballpark of 8%. If you actually go to actually the first position in terms of, say, return expected is the US, 8.3%. And this is really on the back of actually strong and sustained earnings growth and margins, which has been definitely, say, a positive for the US. Second place comes the UK, connected to your, let's say, elements on the positive side, 8.2%. And again, valuation plays a role here. Then comes Europe and Japan with returns around 8%, for different reasons. Japan is more of an earnings story. Europe is more about dividend and valuation. And then comes emerging markets. Emerging markets has less earnings visibility, and reason why we actually have a slightly, let's say, lower expected return, around 7%, is still because there is a relatively little dispersion across regions on those forecasts. What would actually make more sense for investors is to still hold a global diversified portfolio by investing in all those regions and countries. When you then touch fixed income, one interesting element of 2025 has been a different direction on how expected returns changed for govies. So especially on the long end or long maturities, we have actually observed an increase on expected returns. At the same time that for credits, there has been a compression in expected returns. Credits have done an amazing year 2025, and that actually had impact on the 7-year forecasts. Meaning there is some dispersion, but it's still the level of both are still quite attractive. Reason why that also in fixed income, having a diversified portfolio, harvesting carry is still actually very attractive. For the US right now, on the capital market assumptions, we expect 4.5 returns for treasuries, 5.5 for investment grades, and 6 for high yield. So still actually very, very reasonable levels. When you then turn to private assets, there is actually a benefiting sentiment towards the asset class, and which actually allow us to, again, after some 2 or 3 years, or actually somewhat, let's say, bad returns on the private side, private equity side, we have actually now forecast of between 10 and 11% on private equity. When you actually go to venture capital, which is actually the part of private equity which has, let's say, higher return potential, we see 12% returns, but with a much higher variability between managers on delivering on these targets. One interesting part of private asset that we highlight this time is about private credits. Private credits we expect to deliver 9% on the coming 7 years. One very interesting distinguishment there is about the fact that we are very bullish on European private credit, much less so on US private credits, given the saturation of that market. I think perhaps the last element of private assets is about real assets, so real estate, infrastructure, natural resources. And there you will actually get, as an investor, indexed returns to inflation, but also attractive on the range of 8 to 8.5% annualized, which again is actually a very interesting proposition to portfolios, which are definitely underinvested in private assets. I think one thing to close up about that is, again, there has been in 2025 strong returns across different asset classes. Important thing here is, if you're actually building a strategic portfolio, expected returns going forward are still quite attractive, as by the measures that I mentioned. And again, linking to a scenario where we actually have a softer landing happening in the shorter term is definitely, let's say, a good time to be building portfolios, again, as mentioned, in a balanced way, to actually be able to harvest all this premium that we see strategically.
Right.
So, Jose, we have all the pieces for climbing towards new highs in our portfolios.
Absolutely. I think that basically we covered our 3 main ideas together with the capital market assumptions. We really hope you enjoy this report, and we're looking forward to seeing you next year. And until next time, thank you.